If you're looking to generate income from your portfolio with exposure to the S&P 500, well, you might be interested in this NEOS fund. It's the NEOS S&P 500 High Income ETF, ticker symbol SPYI. This is a covered call ETF, which is a category of funds that seek to generate income by selling options. And I've tried to do this strategy on my own in the past to very mixed results. And at this point, I'm turning to the professionals. I'm looking for somebody that really knows what they're doing when it comes to implementing a strategy like this. So I can take a portion of my portfolio and have exposure to the S&P 500, but generate more yield out of it, reduce some of the risk, and create a steady stream of income for myself in early retirement. So let's talk about NEOS, which is a new fund company. In fact, their flagship fund that we're talking about today, SPYI, launched only back in August of 2022. So just about 2.5 years of data on this one. This is an ETF that is actively managed, and I generally try to stay away from actively managed funds. And in fact, in most of my portfolio, it's all passive, buy and hold, boring index fund kind of stuff. But in a portion of my portfolio, I'm trying to find other ways to generate income from it than simply selling shares when I need income. So the 0.68% expense ratio that they're charging here, to me, could be worth it if they can deliver on the promises of the fund. The headline feature of SPYI is the 12% distribution rate, and this fund pays out every month. This 12% distribution rate is based on what they distributed the last time they made a distribution, last month, and then times 12. Now, before we get too far into this, please know that the information and opinions that I'm providing here is just my understanding of this fund based on research that I've done. I will put links in the video description to some interviews I watched and other materials that I found, and this will help you to do your own due diligence if you're interested in SPYI. Now, the objective of SPYI is first and foremost the high monthly income that they aim to produce in a tax-efficient way. The fund has exposure to the S&P 500 and sells calls against the S&P 500 in order to generate income. And they're selling out of the money options on the S&P 500 index. They sell them 1% to 4% out of the money depending on current market volatility. So if the market is less volatile, they're going to have to go closer to the money. It might be closer to 1% out of the money. When the market is more volatile, then they can go further out of the money and sell those options, maybe closer to 4% out of the money. And they're targeting an income of 1 to 1.5% on a monthly basis. So that's the main way that they generate the monthly income. I really like that generally they're not selling calls right at the money. It's not balls to the walls, as much income as possible. They are giving a little bit of breathing room there. And by not selling calls right at the money, they're not completely capping their upside. They're giving themselves a little bit of room for growth, a little bit of upside potential in the S&P 500 in addition to the income that the calls provide. I like this strategy because this is similar to the way I tried to do it. This seems like the ideal way to do it to me. And I presume that these fund managers know how to implement this strategy much better than I could. Now, in addition to giving themselves a little bit of room on the upside by selling calls that are just out of the money, they also don't write calls on the entire portfolio. So they leave a portion of the portfolio completely uncapped without an overlay, as they call it, an options overlay. So they have around 75 to 90% covered with an options overlay, and that leaves 10 to 25% of a long position that they can leave to appreciate as the S&P 500, as the overall market moves higher. Because once again, they have this income target, this monthly target, and once they hit that, they also want to leave room for the fund to be able to grow in value. And I really like that feature of SPYI. Now, SPYI's distributions seem to be consistent from month to month if you look at this chart, but they target that distributions could be between 10 to 12% on an annualized basis, and seems like they've been around 12% for the past year. Now, in addition to selling calls, the fund also allows itself to buy calls. And they do this based on a model that they have. Basically, when volatility is very low, that's when they might buy calls. One of the fund managers in an interview mentioned that when the VIX, when the volatility index was below 10, that's a time they might do this. But apparently, since the fund has existed, the conditions have not been right to actually buy any long calls. We've been in a higher volatility environment, certainly haven't been below 10 in a while. But if volatility gets low enough, they may need to sell closer to at the money options to continue to generate enough income. And then they might take a portion of that income from selling those calls to buy calls. And the idea here is to protect growth, because remember that in addition to income, they want to have a little bit of growth as well. And in a low volatility environment, they're going to try to continue to have some of that growth by buying calls. Because that's one thing I understand about SPYI that I also like, is that they're thinking about income first and foremost, but they're also considering the total return that the fund can generate. Now let's talk about maybe the most controversial, maybe misunderstood part of SPYI, and that is related to its tax efficiency and its return of capital. Most of the distributions that SPYI has been distributing have been classified as return of capital. Now, this sounds bad because return of capital sounds like, oh, you're just returning the money that I gave you. You're taking my capital and giving it back to me. And that sounds basically like a Ponzi scheme. But that's not how this works. In this case, return of capital is done for tax efficiency purposes. It's not return of your principal. It's just designated as return of capital. And the way they do this is that they take losses that they may have internally in the fund, whether that be from selling calls or from their long position. They're going to have losses in the portfolio, and they're going to pair those up with gains, and they're going to it's like tax loss harvesting, basically. So they're going to take losses, match them up with gains to cancel them out. And by harvesting those losses, which they can basically carry forward indefinitely, just the same you would do as an individual. If you had losses one year, capital gains losses, you could carry those forward to the next year to offset gains you might have the next year or the year after that. Same thing here within the fund. And that way they can designate those distributions or a significant portion of those distributions as return of capital. Now, the thing about these distributions that are classified as return of capital, now they're not tax-free, they're kind of deferred into the future. But what it does is it actually reduces your cost basis in the fund. So when you do sell, a year down the road or 2 years or whenever it is, those will be long-term capital gains. So you're deferring taxation, and you're also getting the benefit of when you do realize the taxes, they're going to be long-term capital gains. Another way that SPYI is especially tax efficient is that the index options they use get special tax treatment called the 1256 tax treatment. That means all gains are 60% long-term capital gains and 40% short-term capital gains. Now, I really like the level of flexibility that SPY has in it as far as what their fund managers can do to keep the distributions coming. They can shift how close to the money or out of the money the options they sell are, and they can shift the percentage of how much of their portfolio has that options overlay on it or not. And they can do this to meet the income that they're targeting depending on market volatility. And of course, if volatility is low enough, they may need to sell options closer to the money. And then they might even take a portion of that income from selling those calls to buy calls. I like how the focus is not just on income at any cost, but there's a consideration to the total return aspect as well. As with any covered call ETF, I do have a concern about how this would all play out in a down market, but it's definitely going to play out better than if you just held SPY by itself. So let's talk about how SPYI might perform in different markets. Now, I would expect SPY to underperform SPY in a bull market. And of course, the reason is that a significant percentage has calls sold against it. So that's going to cap the upside. You're not going to get the full upward appreciation of the S&P 500. But in a flat or slowly rising market, that's where I would expect SPY will outperform, because they can still capture some of the upside, but they also are selling the calls to generate additional income. And then in a market downturn, well, I would still expect SPY to outperform, to go down less because it's offset by the income that they receive from selling the calls. But there's still significant downside there, just a little bit less than what you would have owning SPY by itself. The thing about this fund is that it is so brand new, having launched only in August 2022. It hasn't been around long enough for us to see how it would perform over the long term or in different types of markets, especially downward markets. I mean, it's still bull market city and it's working out great for SPYI. In fact, the 1-year total return for SPYI is 17.82%. Compare that to SPY at 22.37%. It's really not too bad, considering you'd be in this more for the income than for the growth potential. But it does include that growth potential as well, which sits well with me and makes me pretty interested in this fund compared with some other covered call ETFs that I've looked at. I also like that the fund managers aren't in there picking individual stocks. They're using the S&P 500, but using their expertise for tax efficiency purposes and managing the options. Now, because this fund is primarily about the income, it's not something I would use if I was deep in the thick of my accumulation phase of investing or just starting out and just trying to build up my portfolio as much as possible. SPY, the S&P 500, the US stock market in general would be expected to outperform SPYI. So this is not something that I would buy in order to beat the market. This is something I would use to generate income in a way that also allows the potential for some upside growth. I'm interested in it more as something to generate some income as I approach early retirement, but the majority of my investments are still in passively managed buy and hold index ETFs. So those are my thoughts on SPYI. I've already invested $10,000 into this fund and am looking to add more to that position if the market should drop. So let me know your thoughts in the comments, and as always, thanks for watching.